C-SPAN.org/Lincoln Book. C-SPAN is directing royalties from this book to the nonprofit C-SPAN Education Foundation.
Now a hearing on retirement security and 401k plans. The House Education and Labor Committee is considering how current economic conditions have affected 401k retirement plans, and they're looking at potential changes to the system. Representative George Miller of California chairs this hearing. It's about 2 hours.
The House Committee on Education and Labor will come to order, and we meet today to explore the shortcomings in our nation's retirement system and look at solutions so that Americans can enjoy a safe and secure retirement. The current economic crisis has exposed deep flaws in our nation's retirement system. These flaws were mostly hidden when the market was doing well. Since the beginning of this crisis, trillions of dollars have evaporated from workers' 401k accounts. Millions of workers have seen a significant portion of their retirement balance vanish in just a few short months. The committee heard testimony last year that the decline has forced many workers to consider postponing retirement or rejoining the workforce if they have already retired. For many retirees coping with rising costs for health care and other basic expenses, this loss in income is simply devastating. For too many Americans, 401k plans have become little more than a high-stakes crapshoot. If you don't take your retirement savings out of the market before the crash, you are likely to take years to recoup your losses, if at all. As a result, we are realizing that Wall Street's guarantee of predictable benefits and peace of mind throughout retirement was nothing more than a hollow promise. And many more are questioning whether our nation's retirement system as a whole is sufficient to ensure retirement security. Workers and retirees have historically depended upon three sources of income during retirement: from the defined contribution plans, the defined benefit plans, and other savings, and Social Security. One leg of our retirement system is Social Security, and this program has never looked better than it does today. When you consider the trillions that employees have lost in retirement investments, thank goodness we didn't get sucked into gambling with Social Security funds in the Wall Street casino. Another leg is traditional pension plans, but over the last 2 decades, many companies have unceremoniously frozen or terminated pension plans. Defined contribution plans, including 401ks and other savings, make up the third leg of our nation's retirement system. However, the 401k is not the supplemental retirement plan as it was originally designed. In fact, more than 2/3 of the workers with retirement plans rely solely on 401k type plans as their primary retirement vehicle. While 401ks are a fact of life, this committee has found that these plans in their current form do not and will not provide sufficient retirement security for the vast majority of Americans. This is why in the short term we must preserve and strengthen the 401ks. Hidden fees and conflicts of interest must be rooted out, and 401ks need to be run in the interest of the account holder, not the financial service industry. Wall Street middlemen live off of the billions they generate from 401ks by imposing hidden and excessive fees that swallow up workers' money. Over a lifetime of work, these hidden fees can take an enormous bite out of workers' accounts. Last Congress, I proposed a bill that would require simple and straightforward disclosure of 401k fees, and Wall Street opposed it. The ferocity of Wall Street's response to simple fee disclosure leads me to believe that they do not want 401k account holders to find out the billions they skim from Americans' hard-earned savings. I finally believe that workers have a right to know exactly how much is taken from their accounts. Every penny contributed to a 401k account is the worker's money, and it should be used for the worker's retirement. In addition, as one of our witnesses will testify today, the interest of investment managers selling retirement products to workers do not line up with the interest of the account holders. Too often, the most marketed investment options are the worst for the workers in terms of expense and performance. Finally, in the long term, we should ask ourselves whether our current system gives workers the ability to ensure a safe and secure retirement. Witnesses appearing today will discuss how the decades-old realignment of our retirement system is putting enormous stress on the Americans' retirement security. Being able to save for retirement after a lifetime of hard work has always been a core tenet of the American dream. Retirees ought to have financial security that allows them to focus on family and friends without sacrificing their standard of living. In the short term, Congress must address ways to improve defined contribution plans. The 401k needs to be more transparent, fair, and operated on behalf of account holders, not Wall Street firms. But we must also ask the difficult questions about the state of our nation's retirement system as a whole and look to see whether we need to create a new leg of retirement security. I hope this marks the beginning of an open and frank discussion on where we are today and what we need to do as a country to create a retirement system that works for all Americans, not just the fortunate few. In the coming weeks and months, this committee and Mr. Andrews' subcommittee will be exploring these issues, and I look forward to testimony of today's witnesses. With that, I'd like to recognize Congressman McKean, my colleague from California, who is the senior Republican on the committee, for his opening statement.
Good morning, and thank you, Chairman Miller. Last fall, as our nation's financial crisis was worsening, the committee held several hearings devoted to the effects of this crisis on retirement savings. We heard some troubling testimony about the state of our nation's economic affairs, its impact on workers and retirees, and a range of proposals for solutions. Some I think we would all agree upon. Others were and remain far more controversial. As I noted in the fall, our economy is in the midst of a serious downturn, constrained by a global credit crisis and burdened by the weight of toxic assets that have made it more difficult for businesses, large and small, to maintain their day-to-day operations, much less to create the new jobs our economy needs. And while it would be easy to dismiss the woes of the stock market as merely impacting the wealthy, the reality is that millions of Americans rely on investments in planning for retirement. Because of this, a downturn in our financial markets can have a real impact on workers' retirement security. While the two major types of retirement plans, defined contribution and defined benefit, have many differences, both are impacted by the overall health of our economic system and by investment performance in particular. 401k type savings plans are invested directly, usually managed by workers. Defined benefit plans require plan sponsors to manage millions in assets over a period of many decades. With the collapse in recent years of a number of defined benefit plans, we've seen the risk to workers and retirees when plans are not effectively managed or when benefits are overpromised and under-delivered. I understand that the bulk of our examination today will be devoted to 401k plans and the defined contribution pension system. I welcome this examination and trust that the information we hear today will be of use to us. I would caution, however, that to the extent we focus on one side of the equation, the defined contribution side, we must not ignore the other. It may be tempting this morning to talk about the risks associated with defined contribution plans and how workers would be so much better off if they were all in defined benefit plans. I think that simply misstates the case. As the Chairman well knows, our nation's defined benefit plans are facing historic challenges in the wake of our financial collapse. While workers with retirement savings and 401k plans are rightly worried about what the market is doing in their retirement plans, workers in defined benefit plans face their own worries about whether their companies will still be standing, whether their jobs will still be there, and whether their promised benefits will be delivered in the wake of this financial turmoil. I hope the committee will pay the same attention to those issues as we move forward. Second, I hope that this morning's hearing will acknowledge the full scope of the challenges facing Americans planning for or entering retirement. I expect we will hear at some length about fee disclosure in 401k plans and the need for improvement. I know this is an issue of particular concern to you, Chairman Miller, and one on which I expect we will again see legislation in this Congress. As I made clear last fall, I think all of us would support improved disclosure that is meaningful and useful to participants. And the question of how we go about that improvement is a fair question for today's hearing. I would caution, however, that we not suggest that investment fees are to blame for the dramatic declines in retirement savings, which our nation's workers and retirees have seen as a result of this historic financial crisis. In a year where the S&P 500 lost 38% of its value, to suggest that the problem is merely one of investment fees is simply not factual or helpful. And indeed, on that point, it bears note that while the S&P lost almost 40% of its value, The best numbers available now suggest that the average workplace retirement savings account lost 27% of its value. Still a difficult loss, but it does suggest that plans can and will vary with performance and their management. Finally, I think it's important to recognize that while our defined contribution system could be improved, it would be a real mistake to dismantle it or nationalize it, as has been suggested in this committee in the past. We have a heavy responsibility in both the legislation we pass and the debates we undertake. In particular, I would make clear that now is not the time to frighten people out of the market. Triggering a widespread exodus from the system would only exacerbate the market's downward trend while cementing those deep losses. I hope members and witnesses will keep this in mind with their comments, their remarks today. Given the fact that historically and over time these plans have become vital retirement savings vehicles for millions of Americans, I'm very mindful that we do not take any step, even our conversations, to discourage that this morning. With that, I welcome our witnesses and look forward to their testimony and yield back.
I thank the gentleman for his statement, and I would just, if I might remark on it, it is the intent of the chair of this committee to have an exhaustive set of hearings on pension security in this country, including public plans, including defined benefit plans, including the Pension Guarantee Corporation, under the leadership of Mr. Andrews and his subcommittee. So we, I think what, as I said earlier, the market shine the light on serious problems with 401k plans. It's also shining the light on serious problems with other pension plans in terms of certainly the expectations of the participants, but also their ability to deliver. Thank you to all of the witnesses for agreeing to testify today and to give us the benefit of your experience and expertise. Our first witness will be John C. Bogle, who is the founder and former chief executive of Vanguard, the mutual fund organization he created in 1974. While at Vanguard, Mr. Bogle founded the first index mutual fund, and Vanguard is now among the largest mutual fund organizations in the world, with current assets totaling over $1 trillion. Mr. Bogle received his BA from Princeton University. Dr. Dean Baker is the co-director of the Center of Economic and Policy Research, which he founded in 1999. Dr. Baker is the author of many books on economic issues, including Plunder and Blunder, The Rise and Fall of the Bubble Economy. He received a BA from Swarthmore College and his PhD in economics from the University of Michigan. Dr. Alicia H. Munell is a Peter Drucker Professor of Management Sciences at Boston College's Carroll School of Management and also serves as the Director for the Center of Retirement Research in Boston College. Prior to joining Boston College, she served during the Clinton administration as both the Treasury Department and the Social Security Administration. Dr. Munell has earned her BA from Wellesley College, an MA from Boston University, and a PhD from Harvard University. Paul Schott Stevens has served as President and Chief Executive Officer of the Investment Company Institute since 2004. Outside ICI, Mr. Stevens' career included various roles in private law practice as corporate counsel and in government service. Mr. Stevens received his BA from Yale University and received his JD from the University of Virginia. Mr. Bogle, you're 80 years old and we're still worried about where you went to college. It's kind of interesting, isn't it? We keep going back in time. Anyway, we're going to begin with you. A green light will go on when you begin to testify. Then there will be an orange light after 4 minutes. We would suggest that you think about wrapping up your statement at that time, but we want you to finish your thoughts and the purposes of your testimony. And then we'll open it up for questions from the committee. We'll go through all of the witnesses first for your testimony, and I believe you're going to have to turn on your mic, Mr. Bogle. And again, welcome to the committee, and we look forward to your testimony.
All right. Am I on the air now?
You're on the air.
All right. Well, good morning, Chairman Miller, and thank you, and members of the committee. Thank you for your invitation to join you today to talk about some things that have been on my mind for a very long time. I think it's perhaps best for me to begin by summarizing the ideal system that I think is the ideal system for retirement savings.
We're going to bring the mic a little closer to you.
Very good. That I've outlined in my statement. Number one, for individual savers who have the financial ability to save for retirement, there would be a single defined contribution plan structure, consolidating all those 401ks, IRAs, Roth IRAs, 403bs, and so on, a defined contribution system, a unitary defined contribution system that would be open to all of our citizens. It would be dominated by low-cost, even mutual providers of services, inevitably, yes, inevitably, focused on all market index funds, investing for the long term, and overseen by a newly created Federal Retirement Board that would establish sound principles for the private sector to observe in asset allocation and diversification in order to assure appropriate investment risk for each participant in the system, and also to assure full disclosure of all plan costs. The board would set, in essence, would also restrict loans very greatly from the system and preclude cash outs when employees change jobs, and would also appraise and approve qualified service providers. Number two, the idea is number one is to establish appropriate investment risk, something we've lost sight of for individuals, and point two is to deal with longevity risk, that other great risk to retirement security, that we outlive our resources, mitigated by creating a simple, low-cost annuity plan as a mandatory offering at some point in all DC plans, with some portion of each participant's balance going into this option on retirement. And number three, and most importantly, we should extend the existing ERISA requirement that plan sponsors, corporations, meet a standard of fiduciary duty to encompass mutual fund plan providers as well. In fact, I think we need to go further. I believe we need a federal standard of fiduciary duty for all money managers who are agents who, in my opinion, have failed abjectly in their responsibility to serve first the interest of their principals, all those mutual fund share owners and pension beneficiaries. And therefore, these agents bear a heavy responsibility for the financial crisis we are now facing. Now, why do we have to reform the system? Well, we need a new system of worker retirement security because the present system is imperiled and is headed toward a train wreck of considerable force. It's not just the 50% plus decline in stock prices that we've seen, with $10 trillion, almost $10 trillion of market value erased, some of which, I should say importantly, I can't deal with it in my opening statement, but it's in my testimony and my prepared statement, some of which represented speculative phantom wealth, overvalued markets developed by speculators and that are described in the statement. So some of the wealth that has evaporated was phantom wealth. But that only begins, that market decline, that big loss, the list of reasons for retirement plans to change the system, for the problems that we have created in the system. Retirement plans own about half of all U.S. stocks, and in turn they've borne about $5 trillion of the $10 trillion decline, a whopping, I'm using 30%, Congressman, but 27% might be a better number, a whopping 27% hit to the retirement system itself. So we are not saving nearly enough, we now know, for retirement. Corporations have been stingy in funding their defined benefit plans, and they have assumed higher levels of return that are even remotely capable of achieving. They are, in effect, a bad joke, the future 8.5% returns that these retirement plans were claiming before the great fall of the market last year. And in addition, they've been derelict in funding their defined contribution plans, largely 401ks, which have a balance of a pitiful $15,000 on the median balance. What's more, nearly 100 companies already in the last year have either reduced or suspended their contributions to their thrift plans just as stock prices have come down by that huge amount, creating some kind of extra value at some point. In addition, pension managers and plan participants have made unwise and often speculative investment choices, too much in equities, especially for investors nearing retirement, too many hedge funds, also known as absolute return funds, now known as absolute negative return funds, too much real estate, and so on. Our financial system, especially our mutual funds and our hedge funds, also are greedy to a fault, and they consume far too large a share of the returns created by our business and economic system. So we must recognize that the interests of our money managers and marketers are in direct conflict with the financial interests of the investors to whom they provide services. If I could just make one more point, I guess my time has run out here, has it? I'd like to just make one more really important point, if I may, that all this trading back and forth among investors is not a zero-sum game. The financial system, the traders, the brokers, the investment bankers, the money managers, the middlemen, Wall Street, as it were, takes a cut of all this frenzied activity, leaving investors as a group only with what's left. Yes, the investor feeds at the bottom of the food chain of investing. So what do we have to do to encourage and maximize retirement savings? Using a biblical phrase, if I may, we must drive the money changers, or at least most of them, out of the temples of finance. Now, here's the most important point in my remarks. I asked you in my testimony to read it twice. If we investors collectively own the markets, as we do, but individually compete to beat our fellow market participants, we lose the game because of those costs. But if we investors abandon our inevitably futile attempts to obtain an edge over other market participants and simply hold our share of the market portfolio, we win the game. It is not very complicated. So that's why, inevitably, we will be focused on stock and bond index funds. Thank you, Mr. Chairman. Sorry to run a little over.
Mr. Baker. Dr. Baker.
Thank you very much, Mr. Chairman, for inviting me to speak here today. I'll say a few points of emphasizing some of the problems which I think are all too apparent in the current system, and also try to throw out some quick thoughts on potential solutions. First point, in terms of the basic problems, I mean, we all know we've just seen a massive collapse of the stock market, and we're facing with a situation where, insofar as people had retirement accounts, and here I'm thinking of the baby boom generation, the 77 million baby boomers on the edge of retirement, they're overwhelmingly in the form of defined contribution accounts. Defined benefit accounts, whether we like them or not, are rapidly disappearing and certainly going to disappear more quickly in the near future as more and more companies freeze their accounts or end them altogether. So we're looking at a situation where if people had accounts, they had defined contribution accounts, of course, and we all know that those have taken a very large hit. Now, on top of that, one of the points that I want to emphasize in my testimony is that the main source of wealth for most baby boomers approaching retirement is housing, and that also has taken a very large hit. And I think this has been, many people fail to fully appreciate the impact that this is likely to have on the retirement of middle-income baby boomers. I know that there are a number of surveys that have looked at baby boomers' intentions to use the equity in their home for retirement, and I know that most of the surveys show that most don't intend to do that. I would argue that in spite of their intentions, I think realistically the vast majority of retirees, and certainly baby boomer retirees, will be at least in part dependent on the wealth in their home for their retirement. And there are three reasons for that. One is that if you have a paid-off mortgage, obviously you're much better situated in retirement than if you have to continue to make payments on your mortgage long into your retirement. Secondly, many retirees do anticipate moving, and it makes a very big difference if you leave your house and have a large amount of equity to use as a down payment or possibly even purchase outright the home that you expect to live in during your retirement years. The third reason is simply that this is fallback money in the event of emergency, in the event of an unexpected medical condition or other emergency that requires money. If you have no equity in your home, then you obviously have much less fallback money. Now, we recently analyzed the Federal Reserve Board's Survey of Consumer Finance. I have to confess, we didn't get the most recent data, which just came out last week. We'll have that shortly, but we're working off the 2004 data, and we just made some crude estimates of what baby boomers can anticipate having in retirement based on the recent declines in the stock market and in housing prices. And our calculations show that for younger baby boomers, those between the ages of 45 to 54, their total wealth, including equity in their home, all wealth apart from defined benefit retirement accounts, has fallen from $150,000 in 2004, which was none too generous, to just $82,000 in 2009. And just to put that $82,000 in context, this is median household, that would purchase less than half of the median house. So we're looking at a situation where half of the baby boomers, half of the younger baby boomers, if they took all their wealth, would be able to purchase less than half the median house. Alternatively, if we converted that into annuity, said they were age 65, that'd get you an annuity of about $6,000 a year, $500 per month. That would not go very far in retirement, again, assuming that you have no equity in your home in that scenario. If we looked at older baby boomers, those between 55 and 64, the situation is almost as bad. We project that their wealth, total wealth, would be $142,700. That's a decline of 38% from where it stood in 2004. that would be sufficient for 80% of the purchase price of the median home. Again, if you took all your wealth and used nothing on anything else, you'd be able to purchase 80% of the median home. Alternatively, the annuity you can get for that would be about $10,000 a year, or perhaps a little more than $800 a month. And again, that's assuming that you have no equity in your home. I think long and short, people were taking much greater risks than they realized, not only with the money that they had in a defined contribution 401k type plan, but also in their home, which they were led to believe was a safe asset. Now, just some very quick points, because I realize I don't have much time. First, and I realize this isn't necessarily the purview of this committee, but I think a point that we can't emphasize enough: the Federal Reserve Board must take seriously its responsibility to combat asset bubbles. I know the Federal Reserve Board under Chairman Greenspan did not feel that was part of their responsibility. I think there's absolutely nothing more important that the Federal Reserve Board could do than to combat asset bubbles, and I think the current situation demonstrates that clearly. They gambled with the wealth of the country's homeowners, and we all lost very badly. Secondly, in this context, I think it's very important for the Congress and President to reaffirm the commitment to Social Security and Medicare. The baby boomers, generations that are retired or near retirement, have just lost on the order of $15 trillion in wealth between their houses and their stock. And we have to assure these people that the one thing they could count on will still be their Social Security and Medicare. The last point, we obviously need to do more in terms of retirement accounts. I'll just say two very quick things about this. There have been efforts to set up state accounts that would be great experiments, California being the most important. Washington State also are very close to setting up state-managed system accounts. These have had bipartisan support. Certainly Governor Schwarzenegger in California has been a big supporter of this. With a little assistance from Congress, I think those plans can make progress. They would be good models, good experiments for Congress to look at. Last point is that given the risks that people have taken that I think many were not willing to take, not anxious to take, I think the opportunity to look at some sort of defined benefit that the government can guarantee, a modest account, say $1,000 per worker per year, I think that would be a very ripe opportunity that could offer a great deal of security to the nation's workers at really no cost to the government. So I realize we have lots of very big problems on our hands. I appreciate the committee's interest in this, and I hope we can make progress on that. Thank you for hearing me.
Thank you. Dr. Munell?
Chairman Miller, Ranking Member McKeon.
I'm not sure your microphone is.
I appreciate the opportunity to testify today about what we've learned about 401k plans in the wake of the financial crisis, and to offer some ideas for strengthening our retirement security. As you indicated, I direct the Center for Retirement Research at Boston College. We look at Social Security, public and private pensions, but also individual saving and work decisions. Even before the financial crisis, we were very concerned about the ability of 401k plans to serve as the sole supplement to Social Security. I'm not here to beat up on 401k plans. They were just never intended to do this. They were meant to be supplementary plans on top of old-fashioned defined benefit plans. They left all the responsibility up to the individuals. All of us individuals make terrible decisions. As a result, balances in these plans were very low. The 2007 survey of consumer finances indicates for people approaching retirement, the median balance was $60,000. That's before the crisis. The Pension Protection Act has made steps to make these plans work more effectively, but they're not a cure-all, and we haven't even considered the drawdown aspects of these plans, which are going to be a huge challenge. Now comes along this huge financial tsunami, and we see that people are exposed to enormous investment risk also. These balances in these accounts have declined sharply. If it was $60,000 before the financial crisis, it's about $40,000 after. The financial crisis has also affected the real economy. We have lost about 3.7 million jobs. Unemployed people cannot contribute to their plans, and unemployed people also feel like they have to tap their plans to help them over really rough times. The hardship withdrawal rate has ticked up. It's still quite low, but my view is that if this weak economy continues, you're going to see more and more people taking hardship withdrawals. The other thing we've seen is employers have cut back on their employer match. They're not doing this because they're evil. They have to make choices, and they're probably doing this instead of laying people off. But it does mean, if it persists for a long time, that people are going to have less in the way of retirement income going forward. The question is what to do with all this, and I think one point I'd like to make is that working longer is going to have to be an important part of the solution. Even before the financial crisis, we argued that working longer was important. We have a declining retirement income system, and yet we have people living longer. Working longer avoids the actuarial reduction in Social Security, lets your assets accumulate, and shortens the period over which you have to retire. For older people who are caught in this financial crisis, in fact, that's all they can do. They really do not have time to save a lot more money. The final point is that working longer can't solve the whole problem. We need to shore up our retirement income system, and I think that has two parts. One is restoring balance to Social Security. Social Security has really shined during this particular crisis. Those checks go out. They provide valuable money, modest benefits, but inflation index and go on for life. We need to make sure that those benefits are not cut back even further. There's no free lunch. We have to pay up if we're going to do that, but I think that's important. The other thing is I strongly believe that we need a new tier of retirement income between Social Security and 401k plans. I think this tier needs to provide benefits about equal to 20% of pre-retirement earnings. I think it needs to be on a funded basis in the private sector. It needs to avoid having people take money out while they're working. Benefits need to be paid out as an annuity. It's complicated precisely how to design it because there's this trade-off between how much you put in and the rate of return. So if you can get high rates of return, you have high contributions, low rates of return. So there's much work to be done there. Perhaps the best we can do is a model, something like the Federal Thrift Savings Plan, but it'd be nice to think if we can do something more creative. The main message I want to leave with you is that we need more organized retirement saving. We have a declining Social Security system, even under current law, as the retirement age increases, and we have a very fragile system of 401k plans, and they're just together not going to be enough for future retirees. Thank you very much.
Stevens.
Thank you, Chairman Miller, Ranking Member McKeon, and members of the committee. On behalf of the ICI and its members who are entrusted with the retirement savings of 46 million U.S. households, I'm pleased to testify this morning. Let me start out, Mr. Chairman, by joining you in your call to, quote, preserve and strengthen the 401k system. Today, half of the nation's retirement assets are invested in DC plans or IRAs. That's more than $8 trillion, and most of those dollars would not have been saved without 401ks. In our view, that's just one measure of the success of the system and of the strong base upon which we have to build. True, the bear market that we're in is wider, deeper, and more unsettling than any downturn in generations, and it has had a significant impact on retirement savings. One large record keeper reports that average balances in defined contribution accounts fell by 27% in 2008. These declines are especially hard on workers nearing retirement, but every 401k saver, no matter what, takes a deep breath before opening an account statement these days, and I know I'm among them. These declines cannot be traced to any fundamental flaw in 401k plans. Balances are down because the stock market is down. The S&P 500 fell by 38% last year. All retirement plans shrank in 2008, not just DC plans, but also IRAs, defined benefit pensions in both the private and public sectors, and the Federal Thrift Savings Plan. There is no shelter from this market storm. Yet, despite these declining balances, working Americans strongly support 401ks. We know this because we examined account records of 22 million DC participants in late 2008. They were not panicking. As of October, only 3% had stopped contributing to their accounts, and fewer than 1 in 25 had taken any withdrawals. Clearly, 401k savers are staying the course. We also surveyed 3,000 U.S. households between October and December. In the teeth of the worst markets in 70-plus years, our survey respondents affirmed their support for 401k plans. Almost three-quarters want to preserve the tax incentives of these plans, and more than 80% reject the idea that government should take over investment decisions for individuals' retirement accounts. Now, none of this is to say that 401k is a flawless system. In fact, we believe it can and it must be improved. In my written testimony, I spell out 7 proposals that ICI believes Congress should consider to strengthen our retirement system. First, we should improve disclosure, not just about fees, but also, as the recent market developments underscore, about risks, about performance, and more. ICI began calling for improved disclosure in participant-directed plans in 1976, 5 years before the 401k was even born. We have strongly advocated that the Department of Labor complete its comprehensive disclosure agenda, and we thank the leadership of this committee for bringing much-needed attention to this issue. Second, to help retirees manage their assets more effectively, we should relax the rules on required minimum distributions. The age for RMDs was set at 70 and a half in 1962, and life expectancies have increased markedly since then. Our research shows that many retirees do not begin to take distributions until they are forced to by these rules. Chairman Miller and Ranking Member McKeon, among others on the committee, recently worked on a bipartisan basis to suspend these rules for this year, and we should build on that work going forward. Third, we need to make it easier for employers to diversify participants out of heavy concentrations of company stock as they near retirement. Workers should not have to face the double risk of losing both their jobs and a significant portion of their retirement savings if a single company fails. Some far-sighted employers have proposed plans to help their workers reduce that risk. We should remove the barriers in current law that block these ideas. Fourth, we should consider requiring all 401k plans to use automatic enrollment and automatic savings escalation. Employers have embraced these features rapidly since the Pension Protection Act was enacted in 2006. We need to watch this trend very carefully and consider whether it supports this fundamental change in the 401k system. Fifth, we must make it easier for employers to offer savings plans and for all workers, even those of very modest means, to save for their future. My written testimony suggests 2 ideas. The first is a greatly simplified employer plan which could reduce some barriers for employers who want to offer retirement benefits. Second, we suggest a novel proposal for R-bonds, a new series of Treasury savings bonds specifically designed to help workers save on a voluntary basis, even if they don't have a plan at work. Sixth, we must redouble our efforts to provide financial and investor education to all Americans at every age. And this is a job for educators, government at all levels, financial institutions like mutual funds, and for that matter, all firms that serve the retirement market. Lastly, as President Obama has emphasized just this week, we must put Social Security on a sound financial footing for the indefinite future. Social Security has been and will continue to be the primary source of retirement income for millions of workers. If Washington wants to bolster confidence in retirement security, it should fix Social Security. We're pleased to offer these reform proposals for your consideration. I look forward to your questions. Thank you, Mr. Chairman.
Thank you very much, and thank you to all for your testimony. Mr. Bogle, I'm sure that I've probably been misquoting you, but I've suggested that you've raised the issue, saying that the issue for investors and savers is a competition between the miracle of compounded interest and the tyranny of increasing cost. And that suggested to me that you believe that costs do matter in the long-term management of people's retirement savings. Is that a fair statement?
Yes, sir, Mr. Chairman. That's a very fair statement. And as far as I can tell you, there is not a single academic study that does anything but reaffirm that point. There's not a single independent financial publication, say Morningstar, for example, that doesn't affirm it in spades. It is basically universally true. What I would add is, however, that, and of course we need better disclosure of cost for employers and employees alike, because costs are the reason that the returns of institutions and the returns of all investors as a group fall short of the returns earned by stock funds and bond funds, as I said in my testimony. What I want to emphasize, though, is that we seem to be relying on the fund's expense ratio, its expenses as a portion of the assets, as the talisman or as the standard of what costs are. And those costs run somewhere between 0.8% to 1.3% a year. That number, Mr. Chairman, grotesquely understates the total amount of costs involved in mutual funds, even when you don't talk about sales loads, which are largely outside of the large retirement plan arena, although they're very tough on some of the smaller retirement plans. And the other cost, which is huge, is a substantial undisclosed transaction cost that mutual funds in particular incur, reflecting the rapid turnover of their investment portfolios. It's absolutely amazing, sir, how these portfolios turn over because the mutual fund industry, it seems to me on the data, has become an industry engaged in short-term speculation rather than long-term investment.
This is the activity within the fund that you might invest in as your 401k plan, and you're talking about the internal management of the shares within that fund.
And just think about this. The average assets of actively managed funds last year were something in the realm of $4.8 trillion. And the total transactions, just guess at what the total transactions, members of the committee and chairman, might be in your mind, and I will tell you what it is. They bought and sold $7.2 trillion worth of securities, trading by and large back and forth with one another. So the elephant in the room, if you will, is the ignoring of transaction costs, which have a huge impact, something like 0.5% to 1% a year in addition to that expense ratio, which is for the fun of it we'll call 1% for the actively managed equity fund. So now think about this. And an index fund, of course, goes for about 1/20th of that 2% because it has neither transaction costs nor management fees, but overall expenses of about 1/10 of 1% compared to 2% for the industry. Now, think about this when you get to compounding this, and this is the point which you quote me, sir, accurately, and that is the miracle of compounding investment returns turns out to be overwhelmed by the tyranny of compounding costs. Let's assume, just for the fun of it, counting a stock and bond portfolio together, that it earns over the next 10 years, let's say 6.5%. That's the nominal return. If we assume 2.5% inflation, just a guess, but probably not one with which most people in the room would disagree, that leaves you with a 4% real return on a balanced investment portfolio, of which costs are consuming 2%. Costs are taking half of the real return, but of course, given that formulation, it's much worse than that, because if you compound 2% and 4% over an investment lifetime, call it 50 years, you find that costs have consumed 75% of the return of the investment. So you, the investor, who puts up 100% of the capital and takes 100% of the risk, gets 25% of the market return. That just doesn't seem right to me, sir.
Well, I obviously agree with you. You know, I've always been stunned that whenever you allocate these costs, and people can argue whether 1.5% or 2% or what's fair and all the rest, and then the internal transaction costs that are taking place within the investment programs that people purchase, the only source of all of that revenue is my retirement. You know, American families make a decision, and it's very difficult for the huge middle-class families in this country, that huge class of people, to make a decision after all of their other obligations to also save. And yet that is the source by which all of this trillions of dollars in transactional fees and others is from. Nobody else is contributing that. There was a while, and it was fairly common that we shared that with the employer, but now the employers have figured out that that should be offloaded more and more onto the employees if they're managing the funds, and on individuals. And so, you know, I'm very jealous. I know how hard people in my district work to create a little bit of savings, and I know, as Dr. Munell has pointed out, how small their total savings are. And if you combine that with what Dr. Baker said in terms of what they thought was going to be an equity account that they had, but they made choices, some good, some bad, we're talking about a population that is in a desperate situation. And I don't think we can tell the next generation of savers that they would want to put their savings at that same risk with respect to cost. Somehow we have got to figure out that the idea of these savings makes sense to the American public to make the determination that they want to participate. And I just think, you know, I think but the struggle, the incredible struggle and the energy put into fighting against that transparency is just really quite phenomenal. You know, really quite phenomenal. But we'll continue on down this path. I just would like to ask, if I might, Dr. Munell, one question in this round of my questioning. You said you mentioned that you'd like something like the thrift savings plan, but we could be more creative. What would be What are you talking about? If I just, and I'll come back to you in the second round, but I just wanted to put that on the table.
There's enormous trade-off between the contribution people have to make and the rate of return they earn. And the question is, can you ensure people higher returns? And so we've really been looking into this issue of guarantees, which is a very tough subject because what you can do according to standard finance theory, if the insurer has the same preference as the market, is very modest. And ensuring 2% real rates of return really would have done nothing over the last 84 years. And the question is, can you somehow construct higher level of guarantees or different ways of risk sharing? But it's not something you want to do casually, but it's really worth looking into.
Okay, I just want to know what the parameters of that discussion were. Thank you. My time has expired. I just want to know, Congressman Hare finally showed up a little late to this hearing. You'd think that someone who just turned 60 would be here early to figure it out. But anyway, happy birthday. Mr. McKeon.
We did that in lieu of singing happy birthday, I guess.
It may not be so happy when he's done with the hearing. He's worried.
I really appreciate your testimony. One of the things that whenever we talk about this subject, one of the things that really bothers me is, I think, Dr. Monell, you made the point that sometimes we make bad decisions. I think human nature seems to be that we always go for the maximum possible return, thinking that that will always be there. I remember talking to a golf pro one time, and he said, every shot it seems like we hope is going to be the best shot we ever make. And I think sometimes we plan our future retirement on that basis. That's, I guess, why gambling casinos are doing so well. People go there always expecting to win, and in our retirements, we expect that we maybe can lose a little bit here because we're always going to make it up on the big play. And I'm wondering how much responsibility the federal government should take in protecting people from bad decisions. Do we have the ability, being that we're all very intelligent and smart here now that we've been elected to Congress, to avoid all of those bad decisions? And you can see how successful we've been lately. Mr. Stevens, my understanding is that the mutual fund industry holds about half of the assets in 401k plans, which means about half of those assets are held somewhere else. Can you tell us where the other half are and how those plans have suffered as a result of the financial downturn, how they've been affected?
Thank you, Mr. McKeon. Yes, it's true. Mutual funds are an important component of the system. But if you look broadly, there are different types of retirement plans, including defined benefit plans who have been hit, as my testimony describes. But there are also other components of the 401k system and of individual retirement accounts which are not mutual funds. We're sometimes frustrated because we are such a large component that we're sometimes identified as the entire system. But you have to consider, for example, products that are sponsored by insurance companies, by banks, and other financial institutions that are part of the system as well. It's one of the reasons, frankly, that we have emphasized from the very beginning the need for a disclosure regime that extends to all investment options that a 401k participant might be able to invest in their plans. We have lived under the regime of the Securities and Exchange Commission throughout our history since 1940, and I think whatever deficiencies people might think there are, we have as comprehensive a set of disclosures on virtually every subject, more so than any other financial product. We've been saying for years that we ought to bring the other components of the system up to something that's comparable, and that's been a very important part of our public policy emphasis now for 33 years. It's certainly gratifying to us to think that that might begin to be the case. Certainly, we're more than happy to talk about mutual funds, but let's not confuse mutual funds with the entire defined contribution system.
Thank you. Dr. Baker, you mentioned something at the end of your statement about we should have another kind of a defined benefit of $1,000. and there would be no cost to the government. How would that work?
Well, the point here, and I think I'm thinking along similar lines to Dr. Minnell, that if we established, in effect, an expanded defined benefit building on Social Security where workers would contribute voluntarily, perhaps with some strong arming by some automatic contributions and default contributions and perhaps subsidies for low-income workers, that we could have an additional amount put aside targeting, say, $1,000 a year, which would be a modest increment to a higher-income worker, but would be fairly large for, say, a more moderate-income worker, where we would guarantee somewhere perhaps 3%, being a little more ambitious than the 2% real return. That could provide a very substantial supplement to
excuse me. The worker would contribute $1,000.
Yes, and the government-managed account, which would then be invested privately, similar to the thrift savings plan.
And who would guarantee the 3%?
The government would provide the guarantee. So the government would be taking some risk, but again, I would just contrast that to the, in effect, guarantee we've given to the bondholders of corporations like Bear Stearns and AIG, where that's being very costly to the taxpayer, and there was certainly no commitment on the part of the government to make those bonds good in advance.
Sometimes we go through periods of growth. Sometimes we go through periods of, like we're in right now, where things really collapse. How would the government guarantee that 3% without any risk to the taxpayer?
I should not say that it's no risk, but it's a very, very modest risk. So if you had a portfolio that was, say, 60% equities, 40% other, bonds, mutual funds, that would, over a long period, there'd be very limited risk that.
How would that vary from Social Security?
Well, the difference is that it would be defined contribution, that people would voluntarily be putting their money in there. So if they didn't want to do it, they wouldn't have to.
Whether they put the money in or whether the government they put the money in now for Social Security.
Well, that's, as you know, that's mandated. In this case, it'd be voluntary.
I see.
So again, voluntary but strongly encouraged.
Why not make it mandatory if it's why not just increase Social Security deductions?
Well, that's something that I think would be reasonable to consider, but I think it is, in this case, it's not a tax. If you do not want to pay it, you don't have to pay it. So we could have a default.
But then don't we get back to where we are right now?
Well, I think
some people are going to live forever and are going to hit the big jackpot at some point. They don't need to worry about it until, they get to be about 55.
Well, in this case, a 3% real return should be consistent with what the financial markets can give over the long term. When I was saying that there could be some risk, we could have a prolonged period, as we may have now, of a down stock market, in which case it would involve some modest commitment for the government.
A couple of years ago would have been great. You went.
I did, and this hearing is going to end at 12:30, so I want to. We'll try to limit going over now that Mr. McKeon and I have gone over. Mr. Payne.
Thank you very much. It's a very important hearing. Just looking over some of the notes that the cumulative decline in the value of the financial assets as a result of the current economic crisis cost Americans almost $2.7 trillion in their retirement savings. As we remember, years ago, the defined contribution, the defined contribution plans were really what was in, and the defined benefit was less popular. Of course, when employers started to end their defined benefit plans, the old type retirement that I used to hear my father talk about, we saw a shift. Even in the 80s, 60% of the workers were covered by defined pension plans and 17% by the defined contribution 401k type. However, just 20 years later, only 11% of the workers are covered by defined benefit plans, and 56%, almost 60%, by the defined contribution plans. Now, if we're having the problem with the market, I guess my question, maybe Dr. Baker might take it. I don't believe that policymakers ever intended that the ability of a worker to retire would depend on whether the stock market was up or down in a particular year. How can we modify the 401 plan so that workers' ability to retire is not dependent on the state of the stock market. You know, like I say, years ago, you had that guarantee coming out. The check would come each month, like Social Security, more or less. But how's the future? It looks bleak right now. My colleague said that we have ups and downs. Look like this down is pretty down and going to be down for a while. Maybe not out, but a 9 count, and maybe like the Dempsey fight, we're trying to have a long count to not call 10. We don't want the knockout. So what do you think, Dr. Baker?
Well, again, I think I agree with you completely that we've subjected workers to a much greater risk than I think any of us realized, and certainly that they realized. And I was making the point that in addition to their retirement wealth, they also had their housing wealth at risk as well. So that's why I was thinking that given the circumstances, I think it does make sense to talk about having some additional guaranteed benefit that could be available to workers. Again, it's possible you would want to look to expand Social Security. I think that's a reasonable thing to consider. But I think to allow workers the opportunity to invest voluntarily in an account that will give them a guaranteed return, I think would be something that would be of enormous value to the country's workers at very little risk. Again, I can't say no risk, sir, but very little risk to the government. I think it's a case where the trade-offs, I think, are very much in favor of offering that sort of guaranteed benefit.
Thank you very much. Well, since the chairman's trying to rush through, I'll stop with the one question. All right.
Thank you, Mr. Chairman. Thank you, lady and gentlemen, for being here with us today. A tremendously important subject, and of course now we're all looking at it, I think, much differently even than we did a year ago. We all, Mr. Stevens, look at our account statements and with some trepidation now. I make my wife read them myself. It works in our house, but I'm a little bit intrigued, and I'm tempted to get in the whole discussion, sort of suggested by Dr. Baker, and that is doing something to kind of shore up Social Security, which I think he's suggesting an additional voluntary effort to put money in, maybe $1,000 that will be guaranteed by the government. And that's a very interesting idea, and one which I certainly wouldn't reject out of hand. But I'm very concerned that one of our pillars here that we're looking at is Social Security, and it is Medicare, and by every measure, by anybody, we're some $50 trillion or more underfunded in those programs. So I'm just kind of reluctant to turn in that direction very hard. Because I don't have much time, let me go to Mr. Stevens. According to the note I have here, and I remember saying this, Professor Monell notes that during this crisis we've had about 2%, I think, of 401k plan participants have made hardship withdrawals from their 401k. Can you tell me, looking at the industry from your perspective, how does that number compare historically to plan withdrawals?
Thank you, Congressman. As I indicated in my testimony, when you actually look at behaviors in the major record-keeping systems, they're very much at the norm that we would have predicted historically. Very little increase in hardship withdrawals. People are not massively taking loans against their accounts. They seem to have an understanding that these are assets that are there for their retirement. With some kind of mental accounting. In fact, I would say in general, there's a tendency to look at 401k investors like they're children who don't know what they're doing. And in fact, if you look carefully at their behaviors, they're much more grown up than sometimes they're given credit for.
They probably let their wife do it too. The Thrift Savings Plan has been used as an example a number of times as an investment plan with relatively low expenses. We've talked about it in the last Congress. I just want to sort of bring us up to date here. And again, going to Mr. Stevens, tell us how it's possible for the Thrift Savings Plan to operate at what seems to be very low expenses. And in general, can you speak to the performance of funds in the TSP during this crisis?
Yes. Well, as I said, the Thrift Savings Plan's funds have been hit like all others. There's been no shelter from the storm in the market. But the TSP really doesn't compare to the private retirement system, and I think this is a very important point to make. The TSP's about 7 times larger than the largest defined contribution plan in the United States. If memory serves, I think it only has about 3 payrolls, large payrolls, that it's got to process. There may be a number of other smaller ones. But you compare that with the literally hundreds of thousands of different payroll systems and therefore record-keeping requirements that exist in the private sector, you don't get remotely the economies of scale. It is also true that virtually none of the compliance and regulatory and reporting and other burdens that exist for sponsors of 401k plans exist for the federal government. Those requirements have been waived with respect to the Thrift Savings Plan, not so with respect to any employer, no matter how small. And remember, most of the employers in 401ks have 100 employees or less, so we're talking about relatively small businesses. And then, you know, it is simply true that some of the costs of the Thrift Savings Plan are not apparent. I'm a former federal employee. There are federal personnel offices up and down every department and agency of government who support the Thrift Savings Plan, and I've never seen an estimate for what their cost is, and it's not reported as an additional cost to the saving of the system. You could think of that as corresponding to any number of activities that have to take place to support 401k plans. So I think it's even more remote than comparing apples with oranges, and just doesn't provide us an appropriate frame of reference in which to think about cost factors in the 401k system by any means.
Thank you very much. Mr. Chairman, I yield back.
Mr. Andrews, and I want to say to the witnesses, not just to do it on Mr. Andrews' time, but to the extent to if you think you want to say something in response, then you can politely figure out how to do that. You're more than welcome to do that. Mr. Andrews.
Thank you. I thank the panel for very, very good testimony that's going to help this process considerably. You know, this hearing would be compelling under any circumstances, but it's particularly compelling when we look at the real pain and anxiety that people all across this country are feeling that's subsumed in that $2.7 trillion loss of pension assets. But we're not here to comment on the size of that loss. We're here because our hypothesis here is that because the 401k system, the DC system, is in need of reform, the loss is worse than it would have otherwise been, and when things get better, the recovery won't be as good as it would otherwise be. So this hearing would be timely whether people had gained $2.7 trillion or lost $2.7 trillion. That's what I want to focus on, is those reforms that I think could make the D.C. system better. Mr. Stevens, one thing I want to ask you, on page 5 you have a graph which shows declines in asset values, and it shows that 401k plans have declined 10.9%. The S&P 500 declined 19.3%. But I do want to understand, though, as you point out, that that includes the contributions that were made to the 401k plans, correct?
Actually, Congressman, the graph on page 5 is intended to depict, as of the third quarter of 2008, the depreciation that different types of retirement
But that depreciation takes into account the contributions that were made to 401k plans. It's not simply their performance net of contributions, correct?
I think that is correct.
Okay. So we're really not comparing apples to apples when we look at the S&P return and the contribution returns. Well, let me ask you this question to supplement the record. If you could supplement for the committee what that number would be if you subtracted the contributions were made and just looked at the performance of the fund as it existed in the prior period, we'd appreciate that. Okay, I think that would clarify the situation. I notice on page 9, in footnote 19, I believe it is, I'm encouraged by your, see, in law school they teach you always to read the footnotes.
They do indeed.
So I'm encouraged by the fact that I think you've extended an opportunity to work with the chairman and with all of us on the work that we did in the last Congress when you say, we agree with the approach taken by the bill reported out of the committee in the last Congress, names the bill, and similar proposals ensuring that disclosure rules apply equally to all products offered by 401k plans. I agree with that. And we would invite your participation as we try to craft good rules that make meaningful disclosure to all participants about all assets. And we appreciate you making that comment. Mr. Bogle, I was taken by much of what you had to say. We appreciate the tremendous contribution you have personally made in this area and your firm has made. Your third recommendation, which is the inclusion of some sort of annuity product as an option, are you advocating that each plan should be required to offer an annuity product as an option?
Each plan, I think, certainly should offer it, and the question is to what extent one should make it mandatory. The idea of locking in or locking out, I guess one would say, longevity risk seems to me to be a fundamentally good idea.
Do I understand your proposal correctly, that what you're proposing is that certain participants would have a certain percentage of their assets put in that annuity-type plan unless they opted out? Is that your proposal?
That is correct.
Okay. Could you describe to us what the annuity product would look like and how it might be designed?
Well, like the mutual fund industry, the annuity industry takes huge amounts of costs out of the returns you get, marketing costs and administrative costs and investment costs. So most annuities are not particularly attractive to annuitants. So we need a better system. I would argue, I think that, I know, that TIAA-CREF, for example, has one of the outstanding annuities in the country, very low cost. But it stands almost alone because the annuities have to support this big marketing system. I don't see any reason that some governmental or quasi-governmental agency couldn't provide just an actuarial-based annuity, but without all those costs in it. And the whole idea is to take the cost out because that's so fundamental to everything we do in retirement savings.
Dr. Mizell, would you care to comment on whether you think that there should be a defined a fixed asset annuity type option included in every plan? Do you think that should be?
I think that we're really going to face, even if we didn't have this financial crisis, that we were going to see a crisis when people retired with 401k balances, because it's really hard to figure out how to draw down that money over an unknown lifespan. And
but do you think we should require such
I think it should be a default in 401k plans. It's not as obvious as automatic enrollment, but I think it's the better option to have the default be an annuity, and then people can back out.
But if I just may ask one more quick question, is it there's a subtle difference between a default position and an option that must be offered, right?
If you just offer it as an option, no one will take it. People hate annuities, so I think
not everyone.
I think you put them in, you let them try, and
okay.
And then if they don't like it, they can go to their HR people and get out. But that's where you put them.
Thank you very much,
Mr.
I
Castle.
think if I could say quickly, I think your question was whether it should be mandated, and I think we'd agree that it should. Every plan should offer that at least as an option.
Okay.
No,
well, Doctor, I think, yeah, I think the Boston College folks wanted to be a QDIA type, a default, but not offered as an option per se. Is that what you're saying?
I'm saying every plan should have it and
right.
Put everybody in it when they retire. Mm-hmm. And then people can say, oh, this isn't right for me, I have cancer.
So if you don't if you don't pick a vegetable, it has to be Brussels sprouts. Okay.
Mr. Castle, help us.
Good luck. Thank you, Mr. Chairman. Dr. Monell and Mr. Stevens, you both mentioned the fact, something to the effect of we have to shore up or firm up Social Security. We in Congress say this on a daily basis in speeches we give or whatever, and then it gets down to the specifics of how do we do this. I realize that's a little beyond perhaps the context of this meeting, but you mentioned it, and I'd be curious as to whether you have any specific ideas about how to so-called shore up Social Security.
Shore up Social Security. People say, oh, we can do some with tax cuts, benefit cuts, and some with tax increases. Social Security replacement rates are going down under current law as the normal retirement age goes from 65 to 66 to 67. For people who continue to retire at 62, you're going to see very low levels of replacement, and they do tend to retire at 62. So I think that anything that cuts benefits any further is really dangerous and going to put people at risk. So, but there's no free lunch. I don't think we're going to grow ourselves out of it. So that means more revenues in somehow. And so I would, put in the estate tax. I would change the COLA. I would actually index the full retirement age to longevity, and then maybe put in some more payroll taxes. But I think it's important to maintain it as the backbone of our retirement income system. We have seen that we really need it, and we should do what we have to do to fix it.
If I could quickly point out the small free lunch.
the question as
Oh,
well,
I'm
if I
sorry.
could
Okay,
respond.
me too.
Oh, we do not have a plan to fix Social Security. I consider it a bit above our pay grade. I would say that we have never supported the idea of private accounts in Social Security. We believe that the Social Security system should essentially say the system that our grandfathers knew and grandmothers. It's the best inflation-adjusted annuity that anyone will ever receive, and it ought to be maintained as such. Among individuals who are over age 65 and who are no longer working, the bottom 50% ranked by income get 86% of their income from Social Security. That's not new. That's been the same since 1980. And it is very important to maintain that stability of income and replacement value for the lower income workers in the United States.
Thank you. Mr. Baker, do you wish to comment on that?
Yeah, very quickly, just the sort of pseudo-free lunch I was going to refer to is that one of the problems facing the program was that we had an increasing portion of wage income going over the wage cap as there had been an upward redistribution of income over the last 30 years. There's early evidence thus far that that redistribution is being reversed. In other words, there's been a big increase in wages for those at the middle and bottom. If that persists, and we don't have enough data yet to say that will be true, if that persists, that will substantially reduce the projected shortfall in the program, since more income will be subject to the tax. A larger portion of wage income will be subject to the tax. We don't know that will stay the case, but at least thus far, it looks like that was one outcome of this crisis.
Well, I hope you're right, although the crisis makes me nervous that perhaps that's not going to happen. But let me ask you another question, Mr. Baker. I think you said that the Federal Reserve should combat asset bubbles. Is that correct? And if so, how would you combat, how should the Federal Reserve combat asset bubbles?
Well, I did say that, and I think the Federal Reserve has a variety of tools that it can use. But the first tool that I would have used, had I, if you're going to make me Federal Reserve Board Chair,
yes, we'll
would
do
have
that
been
temporarily.
to basically use the bully pulpit of the Fed, to use their congressional testimonies, use their other public speaking opportunities to call attention to the misalignment of asset prices and the fundamental realities. I think it was easy to see that in the case of both the stock and the housing bubbles. You had very clear evidence that these prices were out of line. If Chairman Greenspan had used his public speaking opportunities as occasions to point that out, backed it up with research from the Fed, so I don't just mean mumbling irrational exuberance, I mean pointing out here is why real estate prices are out of line with the fundamentals in the market, it will end badly. If he had used his bully pulpit to do that repeatedly, I think it could have had a very large impact. Now, obviously, they have regulatory authority. They could have prevented a lot of the bad mortgages that we saw and that contributed to this. But first and foremost, I think that bully pulpit is extremely valuable, and he wasted the opportunity to use it.
Does that pertain to others, like members of Congress, chairs of committee, and the President of the United States? I mean, it's not just the Federal Reserve, in other words. It's
Absolutely. I mean, this was the most important problem, economic problem, facing the country over the last 5 or 6 years by far. I mean, everything else that we, and I'm not saying this in retrospect, I was saying this at the time, everything else by comparison is really small change.
Very quickly, Dr. Mnuchin, I think you talked about, I came in the middle of your testimony, but I think you talked about another tier of up to 20% before retirement or something of that nature. In other words, it sounded like a new program. Can you briefly, and maybe it was in your writing, which I haven't read, but can you briefly tell us what that's all about?
Yes, I firmly believe that just having 401k plans, no matter how good you try to make them, and Social Security as the only two components of our retirement income system is not going to provide people with enough money. I think that people at the low end who are going to get less from Social Security going forward are going to need something more, and I think that people with 401k plans are also going to need more than just these balances that they have now. And so I think we need a new tier across the income groups for everybody, and let the poor old 401k plans go back to what they originally were, which were sort of supplementary plans, almost play money for people who had solid coverage to begin with. They weren't designed for this, and we keep trying to tweak them to make them work better, and they do work a little better, but they're still flawed.
Ms. McCarthy.
Mr. Chairman, could I?
I'm going to move along here. I mean, we'll try to figure out how to get your comments here, but Ms. McCarthy.
I want to thank the panel for the information. It's been very helpful. One of the things that I'd like to go into a little bit deeper, Mr. Stevens, I know you basically support financial literacy programs, which is something that I'm trying to work on the Financial Service Committee to get all that in. That's been a battle for a number of years. But one of the things that you spoke about was the importance of relaxing the required minimum distributions rules to individually aged 70 and a half. As you point out, Congress worked in a bipartisan manner to suspend the rules for 2009, and you're talking about basically making that permanent or a lock-in for the losses. Could you elaborate why Congress should consider an extension of the minimum distribution, a waiver, or permanently raising the age trigger from the current 70 and a half, and anybody else that wants to jump in?
Yes, ma'am. Thank you. The 70 and a half age at which required minimum distributions are triggered now has been the standard for many, many years. In the meantime, life expectancy has grown, and it seems to us a very reasonable accommodation to Americans in retirement who are trying to manage their assets to give them more time before they are required by law to begin drawing down their retirement account balances. When we asked people about this, fully 60% responded that the only reason that they were withdrawing from their retirement accounts was because they had reached that magic age and the law required them to do so. So obviously there are many Americans who are in a position where they can husband these assets for a longer period of time, and given life expectancy and given other pressures on retirement assets, we ought to help them do so.
Does anybody else have an answer to that?
I would support looking at it, but the reason it's there in the first place is that so these aren't estate planning tools. So perhaps we can make the age later, but I think that it would require careful study, and you definitely want some age.
Just very quickly, I think the concern about locking in losses is perhaps exaggerated, because keep in mind you only have to cash out, is it 6%? It's a relatively small share. I think you'd find very few people who reach the age of 70 who are invested 100% in equities. In other words, almost all of them would have enough in bonds or money funds that they would be able to meet that distribution requirement without touching their equities.
Now, my point was not they're locking in losses, but they're having to withdraw from their accounts however they're invested.
I'll yield back balance of my time.
Mr. Guthrie.
Thank you, Mr. Chairman, and thank you for conducting this meeting. This is extremely important for people. I know now that we've changed the systems and then they've changed and people are now mostly not in defined benefits. They are approaching retirement age, a lot of people in that group. So I know this is important. They're facing this. And Mr. Stevens, you were going to make a comment to Mr. Castle and have the opportunity to make. We ran out of time. Did you get to make that? If so, I'd give you the opportunity to do so.
I didn't. Thank you very much. No, much of what you've heard this morning assumes that there was a point in time when the vast majority of working Americans enjoyed the benefit of a defined benefit plan. This is a nostalgia we have, I think, as a country, and understandably, for an age that never existed. Before 401ks came online and the rise of the defined contribution system, only 16% of Americans in retirement, 16%, received any payment from a private pension plan. And the payment in today's dollars represented $6,000. So the golden age of the gold watch simply never existed. So the idea that somehow or other defined contribution plans came and displaced this wonderful paternalistic system of defined benefit arrangements is simply not true.
Anybody else want to comment on that?
I mean, can I just respond to that? I mean, there was a period in which everyone who had a pension did have a defined benefit plan, and that has changed to a situation where everyone has a pension, has a defined contribution plan. The defined benefit plans weren't perfect, but one has really displaced the other.
So the comment is if you had a pension, you had defined benefit, but still 16% had pensions, if that number is correct. The 16% is what we're...
Or the inverse is 84% had no form of pension, and you have to think of what defined contribution has done to enlarge some pension provision for working Americans, and that was my point.
Can I just add one comment? If you take a snapshot of the private sector workforce at any period of time, and this has been true from the 70s right to the present, roughly half of the people have any employer-provided pension of any sort. And in the old days, 1980s, those were defined benefit plans. Today, they're defined contribution plans. So the percent of the population with anything has not changed, but the nature of what they have has changed.
Thank you. Well, one more, and then I guess I'll yield back after this comment.
I think it's important to understand, too, that in the traditional defined benefit system, you had to spend a long time at a single employer and then retire from that employer to get the pension benefit. The reason defined contribution plans have become so popular really has to do with the fact that that's not the working model any longer. Individuals will have 7 to 8 different employers during the course of their lifetime, so the DC plan is a better fit, in our judgment at least, than the conventional DB plan.
Thank you. Thank you, Mr. Chairman. I yield back.
Mr. Wu. Mr. Wu, not here. Mr. Kildee's in. Who do we have? Ms. Fudge? Yeah. Marshall. Fudge. No questions? Mr. Bishop is not here. Mr. Sestak, there you are. Gentleman is recognized for 5 minutes.
Thanks, Mr. Chairman. Mr. Bogle, if I
see if you can use Ms. Serrano's mic.
Congratulations. Yes,
no.
I can. Oh, I can.
Yeah, let's. I don't know why the.
This is working.
Yes, I can.
question has, make sure that I understand it. It seems to me as though that what you're most interested in is trying to spread the risk of investing to the entire group of investors. And that's kind of your bottom line that I'm taking out of this.
Correct.
You don't seem as interested or feel it's as apropos to getting to that overall objective by, if I read your testimony right, by debundling all the various fees. That's nice, it's interesting. We'd like to know, which we don't know, that you have an expense ratio, but we really don't know the 0.5 to 1% that's added on because of transaction cost. You'd like to make that apparent. Right. Further debundling is nice on the margin. What you really want to do is spread the risk to the market as a whole. Do I get it right?
Yes, but I'd say, sir, only partially right. And that is, with respect to the equity risk, it is mathematically correct to spread the risk as widely as you can, and then all investors as a group will win. Where if they're fighting with each other in the marketplace, which is the way the markets work, just like the casino or the racetrack or the lottery, they're going to lose. So, yes, absolutely correct with respect to the equities. However, I don't think we've given much attention at all here today to something we should give a lot of attention to, and that is one of the things that went wrong is that we didn't spend nearly enough time on educating investors about the risks of stocks and the need to have a bond component of their retirement plan. And for more years, more decades, maybe 30 years, I don't know how many years, I've been saying investors ought to be very conscious of a balanced program. I mean, I grew up since 1951 with Wellington Fund, which is a balanced fund, and that was my first defined contribution plan investment in 1951. So I've been at it for a long, long time, and it's worked great. But the reality is that, and what I've been saying for at least 3 decades, is your bond position should have something to do with your age. Because things happen when you get older. I don't want to get into all of them, to say the least. But among the things that happen are you have less time to recoup bad times, you have more money at stake, and you probably get a little more jumpy when we get this crazy stock markets like this one, which is certainly a once-in-a-generation
And so your proposal would be that your Federal Retirement Board would mandate the shares that go towards the bond index as opposed to the stock index?
Yes, sir, I do. And however, I would, not make it rigid, maybe a range in bonds. In other words, if you're 65, you wouldn't be bound to 65% in bond. If you're 65 years of age, you wouldn't be bound to 65% in bonds, but maybe somewhere between 50 and 80%, depending on your own requirements. Just to get a little protection against these things that happen in this life that we don't expect.
The last question I had, again, for my edification is, you know, in your great article, Black Swan, you called it an expectations market, but I think here in your testimony you called it the phantom. My question is, if you really do move towards an index type of an approach, here in your testimony you talked about between 1999 and today we were actually had, I think, a 7 or 8% loss on the stock market when you know, in reality, rather than the 12% that had gone from 75 to 1999. How do you remove the what you call the croupier from that? How do you, I mean, is it because everything's an index fund, or you just let those that still want to go over to the non-index, that you still let the...
Well, there's a reality, and we in the financial system, I don't think, honor that reality very well. And that is, reality is that stock returns come and go. But in the long run, the whole idea of investing in equities, just working on that part of the portfolio, is to capture the returns that are developed by American business, as I said in my statement, the dividend yields and the earnings growth. Because over 100 years, that is 100% of the return that you get if you invest in stocks before those costs are taken out. The problem is the markets go into these crazes of speculation, irrational exuberance, call them what you will, where we had 2 consecutive decades in the 80s and 90s where we had the price-earnings multiple, which is speculation, how much people will pay for a dollar of earnings, and it went from 10 to 20 to 40. And at 40, buying stocks is basically a bad joke. It can't recover from that. So we're now coming back. Unfortunately, the earnings are fading away at this moment in time, but that will take care of itself in time. But we have to focus on investment return and try and avoid getting captivated by this speculative return. And yet, in all the data you see from the industry, they just ignore what I would call, as I did in my statement, these phantom returns that markets periodically develop and have been developing, you know, since tulip mania, or maybe even before that, maybe since ancient Greece, as far as I know.
Mr. Polis.
No additional questions, Mr. Chairman.
Ms. Shea Porter.
There we go. I have a couple of questions. First, Dr. Mundell, I heard you talking about raising the age for retirement, and if I heard that correctly, that what age were you proposing?
Well, there's a fact that already in the current law, the age at which you get full benefits has moved to 65 going to 67.
I do.
And that means that people retiring at 62, which is when people retire, it's not desirable, but it's when they do retire, are going to get less and less. And so that's just built in the cake. And it means that when you look at Social Security going forward, people are going to get less than they think. Replacement rates are really going to be going down over time. So it matters enormously what's on top of Social Security. And I just want to repeat again and again, is my view is that 401k plans, even fixed up 401k plans, are never going to provide people with enough additional money. And we need this another tier between Social Security and 401k plans so people will have enough in retirement.
Okay, and do you support raising the cap on Social Security so that people at higher incomes pay on the dollars like those in the lower incomes do?
Oh, I think you can raise the cap somewhat, but I think that it's really important that there's some link between contributions and benefits. I think it really strengthens political support for the program. So do it, yeah, it can go up somewhat, but do it cautiously.
Okay, so raising the age is the direction you're looking at. I also wanted to ask you about this new plan. Why not put everybody into the TSP? Would that work? If you want this new layer there, that everybody gets enrolled in the same plan that we use?
I think there's just 2 issues that are important here. I think that for this additional tier, I think it's important that it's basically a private sector activity. I think we've got Social Security, which will provide a good base. It's pay-as-you-go. It's publicly run. I think you want to diversify your risks. Pay-as-you-go systems have demographic risks. funded systems have capital risk, and I think you want some of each. And so I think the TSP is a good model in terms of index funds, low cost, but I think that any private sector firm that could meet those should be able to compete for the available monies.
Okay, thank you. And Dr. Baker, I heard you talking about the housing bubble. Is there anything else you wanted to add about your testimony that you hadn't been asked before?
Well, I guess I would just emphasize the point that for most middle-income Americans, most of their wealth in retirement is going to be reflected in their house, and I think we had wrongly led many people to believe that that was a secure asset, and I think it's very apparent to people today that it's not, which raises the, to my mind, raises the argument, increases the strength of the argument for providing some sort of defined benefit plan in addition to Social Security, because people do need some security in retirement, and not only are they risking it with their 401k accounts, but they're also risking it with their house as well.
So looking 15 or 20 years out for a couple who's just buying a home, your message to them would be plan to live in your house and enjoy your house, but make sure that you have something else, that it's not going to be the traditional cash cow that it was at the end.
Well, simply that there's risk, yes. I mean, certainly we hope that housing values will, eventually stabilize and that they'll at least rise in step with the inflation as they have done historically. But people have to recognize that there is a big element of risk there. We can't guarantee that your house price will appreciate. And clearly, there always was that regionally. So many people, even during normal market times, took a big hit on their home values. But certainly you can have very erratic movements as we see in house prices. So it's not the rock bed of your retirement.
Okay, thank you, and I yield back.
Thank you. Mr. Altmaier.
Thank you, Mr. Chairman. I want to ask Mr. Stevens to get specific about a couple things. One is you outlined a number of proposals to improve the 401k system, and you mentioned specifically in your testimony increasing automatic features into plans, increasing investor education, ensuring Social Security is on sound footing, as we've discussed, and others. And I want to ask you, can you prioritize some of those for us?
Well, it seems to me that since Social Security is the bedrock upon which all retirement planning in the United States has got to rest, that as a confidence-building measure in Americans' ultimate retirement security, that's a good place to start. I would say that there are very specific things that we can do about the 401k system, and as I indicated, we strongly support the Chairman's leadership on improved disclosure, and do want to work with the committee as you continue to consider those issues in this Congress. It's important at long last that 401k participants get the kinds of disclosures that will help them in their investment decision making. That, in a sense, is a step towards improved education, information, and the like. That's a broader national priority. I would think, in light of the downturn in the markets, that a similar step that we could take now has to do with required minimum distributions. Undoubtedly, there are people who are at reaching the age of 70 and a half or thereabouts who are saying, boy, I'd like these assets to be with me a bit longer, but I've got to take them out of my account. And so just as we did in sympathy to their plight in 2009, we ought to look at what more we can do. I think that the committee has the opportunity to seriously consider the rapid acceptance of these auto features that were characteristic of the Pension Protection Act, that I think universally are now acclaimed as having not only gotten many more people covered by 401ks, but increased the level of their contributions. The behavioral economics behind them, it seems to me, are demonstrating their validity. And at some point, perhaps in the not-too-distant future, it's worth considering that we essentially make a plan that's offered by an employer an opt-out, not an opt-in arrangement. That could cover many more people. And then finally, the toughest thing, Congressman, is how you get more of those 50% who aren't covered by a plan in their workplace into the system. That raises many, many larger and more difficult considerations, but that certainly is something that the Congress ought to work on, because there clearly are people who do not have the opportunities we would like them to to invest and to save whatever they are able to for retirement.
And similar to that, you mentioned in your testimony and again in the Q&A that 401k plan is so successful, in your opinion, because it integrates both consistent contributions and long-term investing, which is what you said in your testimony. Can you elaborate on that? And are you trying to make the point that savers should take advantage of the benefits of dollar cost averaging, which means acquiring more shares during market downturns like we're in now?
Yes, thank you. And it's actually the point I was trying to make in response to the question from Congressman Andrews. On page 6 of my written testimony, you have a depiction of what happens in a market downturn for consistent participants in 401k accounts. Yes, their account balances do dip, but because 401k combines the power both of consistent savings and potential returns on investing, what you see is that the participants' accounts continue to climb at a faster rate than the stock market. It's evidence to us, and this is in the context of a market downturn in recent years that was reasonably significant, that if you stay the course, dollar cost average, and continue to save and realize the investment potential when the market recovers, that's a very, very powerful mechanism for increasing your retirement wealth. And the demonstration of that is for us in the chart in that page of my testimony.
Thank you. No further questions, Mr. Chairman.
Mr. Price.
Thank you, Mr. Chairman. I appreciate the panel's discussion. I apologize for being late and having a conflict. I've heard some of the testimony back in my office and read much of it. Clearly, there is an attractiveness to certain returns. If we remove risk completely, however, we remove reward. I think all would agree with that. I wonder, Mr. Stevens, if you might comment on one of my great concerns has been the role of the federal government and how the federal government can I believe, step over a line that varies, but step over a line and then result in decreasing return on investment to all folks, and specifically in 401k plans. For example, the great discussion that's been going on over the past couple of weeks about the nationalization of banks, and you see bank stocks decreasing significantly, I believe, because of that discussion. Do you have any thoughts about, as it relates to 401k plans and the intrusion of the federal government in roles like that?
Thank you, Congressman. And let me give one example, and it is the issue that concerns us all about the decumulation phase. It's people who are now in retirement. They have a stock of retirement assets, and how should they be managed? This is certainly an issue that both public policy makers like yourselves, people who are outside experts like my colleagues here, participants in the financial community, and individuals are wrestling with. My concern is that if government says, we have the solution, it's this, it's nothing but this, what happens in the marketplace is all other experimentation and all other, if you will, innovation, competition, etc., essentially stops. We spend a lot of time thinking about these things, and what I believe is that there is no one right solution for everyone at the point of retirement. Now, some of my colleagues here think that we can't trust Americans with their retirement savings, and we need to force them to do something so there's no more risk in their portfolio for the balance of their life. We talked to the American people in December. Again, markets were pretty bad, and they told us overwhelmingly, we don't want Washington telling us what to do with our investments. There is tremendous competition and innovation in the market by annuity providers, by asset managers, by the two working in tandem to try to give people tools to manage that longevity risk. I think we ought to encourage that kind of innovation in the market. It's what's created the strengths of the 401k system to date. So I would think there are conditions in which competitors ought to be encouraged to meet in the marketplace, and the government has an important role there. Accountability to the investors, transparency in the system, but let's not straitjacket it, because ultimately the participants in these plans and American retirees are going to be the losers.
Yeah, no, there may be some merit to the American public's concern about the advisability of federal government control of whatever they can do with their retirement savings. one of the other lines I think that we can pass as a nation is to increase regulatory burdens so much that we stifle any flexibility or ingenuity within the market of pension planning, 401k planning. Do you believe that there is what would the consequences be, I guess, to employees or employers who would voluntarily choose not to participate if the regulatory burden increases to such an extent that they believe that it's something a hurdle over which they can't go?
Well, it is important to remember that this is a voluntary system. Employers are not required to have 401k plans. They are a benefit that they elect to have and to provide to their employees. And I think that one of the persistent problems about moving beyond the 50% who are covered now into smaller and smaller workplaces are the kinds of burdens that employers have to bear. It's one of the reasons that a lot of the thinking in the sort of expert community has been dedicated towards simplifying 401ks, making them less burdensome, more manageable for smaller employers, so that they would have the wherewithal to adopt a plan and make it available to their employees. And I think that's an important objective. It's one of the specific recommendations that we made in our written statement.
Are there specific activities that you believe that Congress ought to avoid in terms of regulatory imposition on 401k plans?
I think mandating specific investment options is one important one. Attempting to manage from Washington all of the risk-return characteristics that exist in these funds, and essentially substituting your judgment for the judgment of the employer who sponsors the plan. In the design of the system was a judgment by Congress that the employer, as a conscientious fiduciary held to very high standards, is in the best position to make those decisions for his or her workforce. And that system has had a lot of success. And despite the market downturn, we see no reason why it should be overturned.
Mr. Hare. Thank you for your response. Thank you, Mr. Chairman.
Mr. Hare.
Mr. Bogle, I apologize. I missed your testimony, so if I'm going over something you've already talked about, I hope you'll bear with me here. This also goes with being 60 years old, evidently. In your testimony, you called our financial system greedy, and you pointed out the imbalance between corporations and hedge funds managers and the investor who feeds at the bottom of the costly food chain of investing. So I have about 3 questions here, and then I'll be happy to hear what you have to say. What can be done to change this? Do workers have any means at all to defend themselves, particularly when they reach their retirement age and they see that their 401k plans are losing half their value, or find out that their employer cannot pay out the promises that he or she made? And then finally, from you, what protections do they need, do you think, from us?
Okay, well, let's start off with the great advantage of 401ks compared to defined benefit plans, and that is you're not at the risk of your employer's financial security or stability and the risk of bankruptcy. And if you just take a look at, for example, General Motors, you can describe that as a corporation with a $75 billion pension plan surrounded by a few automobiles. And the few automobiles happen to have a market capitalization of something in the range of $1.5 billion. Once you get these huge disparities in the system of competitive capitalism and creative destruction. So you could, and I think should say, the decline of the defined benefit plan in favor of the defined contribution plan is a plus. Now, the pluses for defined contribution are you can take it with you when you move jobs. That's very important. You don't run the risk of corporate failure. That's very important. You can make your own asset allocation, something I've talked about a couple of times here, and that is a typical corporate plan. Used to be defined benefit plan. Around 60% stocks was the convention and 40% bonds, but that applied in effect to the youngest workers and the oldest workers. It was a package. In the defined contribution plan, you can set your own allocation, gradually building up the bond allocation as you grow older, and that's a big plus. The big minus, to get back to the first part of your question, the big minus in the defined contribution plan is it costs about 2 times or 3 times or 4 times as much as the defined benefit plan, because we're all paying individually for those services instead of collectively. So how do you get away from that? How do you get a better system? Well, there are really just 2 ways. One, wake up the investor to his own economic interests. This is what we can call the invisible hand solution. You know, if we each will just operate in our own best interest and our own economic interest, we'll gradually move to a very low cost, certainly an index system over time. And that's the way the market has moved over 2 or 3 decades now, first very slowly and then decently rapidly in recent years. So the investor has to be aware of owning the market and of keeping costs down. And that's a very important part of it. The other solution, and I come back to this and I mentioned it in the testimony, is the institutional investors out there, including the mutual fund managers, really have not done a very good job of protecting the interest of their shareholders. Where are all our financial analysts in this industry when Enron went down? Did they not know what was going on there? How about when Citibank and AIG went down? I don't think our security analysts and our institutional analysts, I know what they're paid all that money for, but they don't delve very deeply. Why aren't they challenging the corporations out there? Where are you going to get that 8.5% return a year ago? And now it's got to be obviously a lot more than that to make up for what was lost in that year. So the institutional investor is, when you think about it, and this is pretty much known, I mean, read brokerage reports on money managers that are publicly held. The institutional investing has become a game of gathering assets. Why? Because the more assets you have, the bigger your fees are. This is not a complicated mathematical equation. And therefore, and I almost hate to stomp on innovation, but having said that, I would like to stomp on innovation. How much innovation can we handle? Do we need more securitization? Do we need more credit default swaps? Do we need more collateralized debt obligations? Do we need more severing the link between lenders, mortgage lenders, and mortgage borrowers? Has those innovations helped us? No, but they sure as heck have helped the financial system, which has made billions and billions of dollars out of all those innovations. So I think, you know, it sounds kind of funny. I'm all for technology innovation. I'm all for mechanical innovation. I'm all for engineering innovation. I'm all for building a better world through innovation. But they ought to take innovation a little bit lightly when the idea of innovation in the financial business is to enrich the providers rather than enrich the beneficiaries.
Thank you, Mr. Bigelow. Thank you, Mr. Chairman.
Mr. Scott.
Thank you, Mr. Chairman. Mr. Bogle, you've indicated one of the advantages of the defined contribution plan is it's separated from the financial ups and downs of the corporation. Why can't the employee buy a defined benefit and still have the separation? Why can't that be in a separate set-aside account?
Yeah, I'm not sure it's possible actually to set up a defined benefit plan individual by individual. You know, you're dealing with you know, the overall wage profile, the future demands on the company's assets. You're dealing with a pool of assets. I haven't thought about it, sir. I don't see how you can have an individual defined benefit plan.
You could buy as you go an annuity that kicks in when you're 65 and buy shares or something in an annuity and make the individual calculations.
Well, you can do that, of course, sir, but you have to realize, particularly in these days of tremors and toxic assets in the financial business, that there's no guarantee that annuity provider is going to be there when it comes time for your annuity. So I think one has to approach a single person taking a single risk very differently from kind of collectively dealing with longevity risk and investment risk.
Very quickly, I would just say I think the public sector could have a role there if you so chose. So you could provide a backdrop either to private issuers or to offer it directly.
And this goes to Mr. Bogle's original point. We're kind of all in this together. If you take it all together, it's a lot cheaper. We kind of spread the wealth. And if you had a government backup insurance requiring the insurance companies to be solvent, so that the government isn't taking that much risk, but we spread that risk, you could end up with a defined benefit, which I think a lot of people like. You know what you're going to get. The stock market can go up and down. You don't have to care. We heard that on average, the market goes ups and down, drops 20 points. On average, we're still okay. Well, that's fine unless you're a couple of years from retirement. If you're 15 years from retirement, you know, up or down 20%, well, actually, the lower it gets, the cheaper you're buying in. So that works out fine. But one of the things that people like about Social Security is they know what they're going to get. They don't have to worry about the finances. They don't have to worry about the company going up and down. They know what they're going to get. And when we talk about trying to invent this thing right above Social Security, again, Isn't there some way where we can take advantage of the fact that we're all together and improve Social Security rather than what they say reform Social Security, which means when you get down to it, cut it? You're either going to increase the retirement age, you're going to reduce the COLA, you somehow reduce benefits. Can we improve Social Security so that we get a little more rather than trying to reinvent the wheel?
Yeah, I think your, in my own opinion, is that your ideas about improving Social Security are the correct ideas. And Social Security, as other speakers have said, is indeed the bedrock of our system, a defined benefit plan that we all know and love. I think love. The reality is that when you go beyond that and start making contributory retirement plans, such as 401k, the possibility, any defined contribution plan, is going to be limited to a certain portion of the population. To pick a number out of the air, I don't think more than half of our U.S. population can add significantly to their retirement income with something that goes on in additional to Social Security. It's very hard to save money when you're making an inflation-adjusted $18,000 a year, which I think is about the number, the average income adjusted for $1980 today. You know, families just can't do that or perceive they can't do it. And yet in that group, unfortunately, according to David Brooks, they're spending 13% of their income on the lottery. So that's not what we want. We don't want to go there today.
Mr. Scott, if I might, I hate to. I told the witness we'd be out of here at 12:30. I have Ms. Woolsey, Mr. Kucinich, Ms. Hirono yet to ask questions, and I'd like to trim everybody down here to 3 minutes because we're leaving at 12:30. So you can take 3 minutes or no minutes or whatever you want to do.
Could I pose a question and not get an answer, and maybe they could respond in writing? The present taxation of dividends and capital gains is at a historic low. If you put your money into a tax-sheltered account, when you pull out the profits, you're paying regular income. Could you make some comments about how valuable the tax-deferred accounts are when actually your tax rate on the profits might go up?
But we're going to take those off the air, as they say. We'll submit those questions to you in writing. If you can get back to the committee, I would appreciate that. Ms. Woolsey.
Thank you, Mr. Chairman.
For 3 minutes.
Aren't we glad that Social Security was not privatized and invested in the stock market right now?
That's an innovation we didn't need.
That wasn't.
Exactly.
You're absolutely right. But Social Security, to me, was intended, from what I understand, to be a floor, a safety net that people could count on, but they can't live on it. Who can live on Social Security? And the poorest of the poor are forced to live on Social Security, and look how they have to live. So I'm sorry that I missed your testimony. Has there been a thread among the four of you that is common between all four of you that would set us in a better direction so that we can have our Social Security and then have a life beyond it?
I think there's a general consensus that we need to restore balance to Social Security. I'd like to think there's a general consensus that we shouldn't cut back on Social Security benefits, so that means putting more resources into the program. I think where this panel really divides is that can we have 401ks as the only supplement to Social Security? Some people think yes. I think absolutely not. No, even if we fix them up, make them more automatic, we hear all these good things about what a success the system has been, but we also have really, really good data on how much money people have in these plans. And the Federal Reserve just released a new survey showing that people approaching retirement have $60,000 in these plans. Now, the system hasn't been in forever, but that is not a lot of money. And even if you take into account the money that's rolled over into IRAs, the figure is only a little bit higher. So there just hasn't been a lot of money in these plans. I don't think these plans are ever going to be adequate, and I think we need more retirement saving, a new system.
Dr. Baker?
I'd agree with Dr. Monell that I think we need some additional account, and I was arguing the case for having some sort of guaranteed benefit that would be offered on a voluntary basis by the government, a contributory account. I was giving $1,000 per worker per year as sort of the target that we'd be looking to as a modest supplement to Social Security.
Okay. Mr. Stevens?
Yes, and just to clarify, we do in fact think that the 401k system can work to contribute an enormous amount of pre-retirement income. And it is absolutely true, as Dr. Monell said, the people that we're talking about today with that $60,000 account or whatever its balance is have not been in the 401k system by and large through their working life. That figure also doesn't take into account what other financial resources they may have, by the way. When we modeled based upon the EBRI ICI database, which is the largest database of actual 401k accounts that's subject to research in the United States, and we asked on the basis of normal behaviors, not optimal behaviors.
Mr. Stevens, you wrap up here. We're going to take your...
I will, Mr. Chairman. Normal behaviors, over a working life, you can get a very substantial replacement of your pre-retirement income, which with Social Security will mean retirement adequacy.
Ms. Hirono, for 3 minutes.
Thank you, Mr. Chairman. I like the idea that we're going to need another tier besides Social Security and the 401ks, and so obviously I like Dr. Baker's idea, and I was curious to note, Ms. Monell, why you thought that this tier that Dr. Baker talked about should be done by the private sector, since part of the attraction of what Dr. Baker is suggesting is that there would be a guaranteed return, and would the private sector be able to guarantee a return?
I think we would all like to have a guaranteed return.
A modest
Very
return.
nice to have a 20% that you knew that you were going to get for sure. The concept of guarantees is very hard. And if you really need a very high guaranteed return to make it worthwhile. If we had had a guaranteed return of 2 or 3%, it would never have kicked in once during the last 84 years. And so it would not have had any impact. To have had any impact, you really need this very huge guarantee return, and the financial literature says you can't do it unless you can figure out some way about to argue that government has a different set of preferences than individuals. So I think guarantees would be wonderful. Risk sharing of some sort, like in maybe the Netherlands or in Canada, would be good. But I think we need a second tier above Social Security that's substantial, that's reliable, that maybe is not absolutely guaranteed, but is more secure than what people have in 401k plans.
Well, I'm not an expert, but I just don't think that in this environment that people are looking for a guarantee of a 20%. You know, if you can get a guarantee of...
No, I was talking 6.
6, okay, or even 6. I think that sounds like a lot to me. I think there are a lot of employees who would want to be able to contribute it in a voluntary way to a modest addition to their Social Security. These are not the folks that are going to get into 401ks, et cetera. So, you know, if the major concern you have is what is the level of guarantee that will induce people to participate in a voluntary tier program like this, a second tier program, then I guess, you know, we can go somewhere with this idea. So, thank you.
Mr. Kucinich, 3 minutes.
Thank you. I'd like to address these remarks to the panelists, but particularly I'd be interested to see what Mr. Fogel and Mr. Baker would have to say about these observations. I heard your testimony, I've reread it, and with the decline in house values, the decline in the value of defined pension plans, decline in the value of 401ks, workers losing jobs and health care benefits connected with that, and with the understanding that we have an aging workforce and more elderly are in, you know, the workforce is aging, more elderly in the workforce, and are also comprising more of the jobless. Are we looking at a baby boomer generation which is going to be driven into poverty unless we come up with some corrections in our health care, protecting Social Security, and some kind of annual benefit that's guaranteed? Mr. Fogel, Mr. Baker.
Okay, well, let me start by saying that I don't think we are looking at a poverty kind of a situation. You know, the markets are kind of unusual. When they're going up, we think they're going to go up forever, and that they're going down, we think they're going to go down forever. That is not the case. I mean, value gets created when stocks drop by 55%. Dividend yields are higher, price earnings multiples are lower, the ratio of the price of a stock to its tangible book value, all that plant and equipment, technology, all those things, you get much more attractive. And so having had 2 great decades for stocks, 2 great, that was the phantom return I talked about in my testimony, and then a terrible decade, which should not surprise anybody. I mean, this was predictable. I mean, I have speeches I gave at the beginning of this decade, not saying that it was going to be this bad, but saying you could be looking for 2 or 3% return on stocks.
Mr. Baker, does what goes down must come up?
Well, it depends what level you're looking at. I think in many cases we are correcting from exaggerated heights. Certainly that was the case in the housing markets. I wouldn't make any bets on the housing market rising more rapidly than inflation over, some time to come. In fact, I hope it would not, because I'm not in favor of an unaffordable housing policy. In terms of the stock market, I think market stock prices are depressed, but the fact is most of the baby boom cohort doesn't have very much by way of stock, and they're not going to be able to accumulate very much in the years they have left in the workforce.
Unless we make corrections, are we looking at a lot of baby boomers put in poverty? That's what I'm concerned
I would say yes, and in particular you have a lot of people running around this town who want to further cut the benefits that baby boomers have in the name of generational equity, which is rather perverse to me.
Okay, thank you, Mr. Chairman.
Thank you very much. Let me again thank the panel for all of your insights here and answering the questions of the members of the committee. I think this has been a great kickoff to this continued inquiry on pension security by the committee that will be led by Congressman Andrews. I would like to, without objection, submit for the record the following documents for this hearing: one by the Investment Company Institute on 10 myths about 401ks, a statement for the record by Matthew Hutchison, an independent pension fiduciary, a statement from the American Society of Pension Professionals and Actuaries, and a statement from the Profit Sharing Council of America to be included in the record if there's no objection. Hearing none, so ordered.
Mr. Chairman, could
Yes.
I also ask that an article that we had on guarantees be included?
It's on the level?
Yeah.
Okay, without objection. Thank you again very much and as previously ordered, members will have 14 days to submit additional materials for the hearing, and as Mr. Scott submitted a question to ask for Mr. Bogle to follow up on, and we will send that forward. And with that, the hearing stands adjourned. Thank you.